Trading is not only a test of analysis, it is also a test of emotion, patience, and self-control. A trader may have a strong method and still fail if fear, greed, impatience, or revenge shape each decision. Psychological discipline acts as the framework that keeps behavior aligned with the plan, especially when the market becomes unpredictable. The first layer of discipline is preparation. Before entering a trade, the trader defines the setup, the risk, the target, and the conditions for exit. This reduces uncertainty and prevents impulsive choices. A clear plan does not remove loss, but it limits confusion. In this sense, discipline is not rigid pride. It is a commitment to follow a tested structure even when the outcome of one trade is unknown. The second layer is execution. During the trade, the mind often searches for reasons to interfere. A small profit can trigger early exits. A temporary loss can create panic. A missed entry can create frustration and the urge to force a new position. Psychological discipline interrupts this cycle. It allows the trader to treat each decision as part of a long series rather than as a single emotional event. Losses are unavoidable, so recovery must also be designed in advance. A theoretical recovery model in trading begins with acceptance. The trader acknowledges that a loss is information, not a personal failure. The next step is assessment. Was the loss caused by a valid setup that simply did not work, or by a mistaken process, timing, or risk control? These two cases require different responses. If the loss came from a correct process, recovery means continuing with consistency. The trader does not chase the loss. Instead, the trader preserves capital and waits for the next qualified opportunity. If the loss came from an error, recovery means correction. The trader reviews the mistake, updates the rules set if needed, and prevents repetition. In both cases, the goal is to restore stability before confidence turns into overconfidence or discouragement. A practical recovery model usually includes 3 stages. First is reduction of exposure, so that emotional pressure can fall. Second is review, where the trader studies entries, exits, position sizes, and market conditions. Third is reentry into normal operation only after the mind is calm and the method is once again clear. This process protects both capital and judgment. Theoretical recovery also depends on expectancy. No strategy wins every time, and no trader can control the next candle or the next headline. What can be controlled is the ratio of risk to reward, the consistency of execution, and the quality of decision-making over time. When these elements are measured honestly, the trader can recover from drawdowns without turning them into identity crises. In the end, psychological discipline and recovery are linked. Discipline prevents many avoidable losses. Recovery prevents one loss from becoming many. Together, they form a system that supports longevity in trading. The market will continue to create uncertainty, but a disciplined trader uses structure, reflection, and restraint to remain steady inside it.